Hello and welcome to our latest Insider interview. Today in the studio I have with me Gervais Williams, Fund Manager of the Diverse Income Investment Trust. Gervais, thanks for coming in today.
It's a pleasure to be here.
The Diverse Income Trust, it invests across the UK market, but a particular preference for UK smaller companies. Given that UK smaller companies, they're out of favour, but historically smaller companies, they've outperformed large companies. Is that a source of comfort in times such as these?
Yes, we need to be worried if we are moving into recession, the UK recession, potentially a global recession, if interest rates remain higher for longer, and then clearly it's difficult for all businesses, big and small. So it's not a walk in the park for anyone. But what's interesting about small companies is often they're more immature, which means that if they lose market share during a recession in one part of the market, they can sometimes make up for extra market share in others. Specifically, you often find during recessions some of your competitors go out of business, which means that various parts of the market are vacated and you can expand into those areas more easily. And just occasionally there are companies which become insolvent. These are viable businesses, over-indebted, become insolvent, and you can buy those from the receiver, often for a nominal sum, and put more capital, get those staff back to work and generate a disproportionate amount of cash. So coming back to those features, all of those tend to favour smallness over bigness. And so you do find those small companies are affected. Some do go bust at risk, but some don't just survive, they thrive. What's interesting about the smaller company sector is the last time it had a period of outperformance was from March 2020 onwards, right in the middle of the pandemic, right in the middle of the global recession, right in the middle of the period when we didn't know there was going to be a vaccine, was a time when the sort of flexibility and the agility of small caps came through. So we're quite excited really about the potential of the smaller side of the Diverse Income Trust to generate premium returns, as well as the mainstream FTSE 100 companies, which have already been outperforming versus internationals over the last 3 years, to sustain outperformance further going forward, given their cash flow surplus.
And that optimism is despite the fact that the UK economy might enter a recession in 2024?
Absolutely. If you go back to the 60s and 70s, again, this was a period when the UK economy didn't grow very well. We had the 3-day week. We had all sorts of problems with the rise in the oil prices, and particularly quite a lot of companies going bust at that stage. So the UK economy itself wasn't a standout candidate versus global economy. But actually the UK stock market, the mainstream stock market, outperformed not just most international stocks, including the US, the S&P index, by an absolute mile. And the best performing part of the best performing market in that time was the smaller part of the UK market. So that's tremendously excited. For the last 30 years, when I see my clients, I say hopefully the strategy has the advantages that it can generate a premium return versus the UK. And the UK's gone nowhere for the last 30 years, so people think it's a bit of dull. Everything's outperformed the UK. In fact, right now, we're in a position where if we're right about the future, not only does the UK performance continue, but this part of the market has a catch-up, the smaller cap has a period of catch-up and outperforms. And the overall return of the fund is then better than most international strategies, as well as most UK strategies.
And central to that period of catch-up, as you've just mentioned, is the fact that the valuations are so low today compared to history?
Yes, I think actually valuations alone on the UK market as well. When you've underperformed for 30 years, there's not much expectation in there. So if you take a price to book, which is a measure of value, how many assets have you got working for you relative to your share price? And if you take the FTSE 100, it's about 1.6, 1.7 times. If you take the S&P 500, it's something like 4 or 4.2. So you can see the valuation is almost half. Now, nearly everyone says, well, that's all very well. We haven't got all those technology stocks, all those growth stocks. Yes, but what we have is lots of companies which are generating surplus cash. A lot of our companies in the UK market are capital intensive. That means that as the cost of capital goes up, actually the competition dies away. So actually many of these companies aren't just well positioned to survive with their cash flow surpluses, but they're able to take advantage of the weakness of others to actually improve their market positions. So the UK market is cheap in its own right. When you move down the market cap range, then the smaller companies, in our view, are even cheaper. Price to book ratios even lower. And it's that factor which means that when we do get this period of outperformance of small caps, I don't think it's just a 1 or 2 year thing. My own view is that actually the UK market continues to outperform for 10 or 20 years from here. And actually the best performing part of one of the best performing stock markets going forward will be the smaller companies, and they hopefully will also, not every year, but have a long-term trend of outperformance versus the FTSE 100.
And in terms of the mid and small cap part of the market, how much longer do you think investors need to wait for that outperformance? If we're in a scenario of interest rates being higher for longer, will that continue to be a headwind?
Yes, it could be a headwind, but what's interesting actually is it can change just like that. So we don't want another pandemic, But that was actually the catalyst which led to small caps outperforming. You wouldn't have known a month before it was coming, but it came, and small caps did really well afterwards. So we can't always be sure we can tell the catalyst. Clearly, it'd be nice if we can encourage that catalyst going forward. We, Premier Mighton, have been engaging with the regulators, and particularly the government, to say, actually, when it comes to the ISAs, why should they be investing in international companies like Nvidia? Why not keep more of it home? Why don't you ring fence a part of the UK ISA allocation each year to go into UK quoted companies? Now, if the government did announce that, I think that would lead to less selling, local selling in the UK market. I think that would help the performance of the UK mainstream stock market. But I think we'd also see a particularly big catch up at the bottom end of the market with small companies. So it may be quite close. We don't know. What is quite exciting is that we can see there is that period to come, and whether it's sooner or perhaps early next year, we can afford to wait.
Around a third of the portfolio is in AIM listed stocks. Have some companies in that index been unfairly sold off, given that the risk sentiment towards AIM and smaller companies is very low?
The key feature has been there's been overhanging sellers, not many buyers. And so even companies which succeed actually have seen their share prices drifting down typically. Companies which have disappointed, which may mean they're still going to succeed longer term, they may not need any extra capital, but if they've disappointed, their share prices fall even faster. So you've seen certain companies come all the way down. Clearly, even when you succeed, it's quite hard for your share prices to go up. U Group has bucked the trend, but most others haven't. So coming back to it actually, yes, there are some companies which are overlooked. I think the area which is most overlooked is the kind of slightly uncomfortable sectors. So coming back to some of the financials, small financials are particularly overlooked, I would argue. Small oil companies, carbon-based energy companies. Again, I think those which they may be addressing climate change longer term, but out of fashion at the moment. And actually, mining companies again. FTSE 100 companies in this area are standing on P's of 6. So clearly, small companies are standing on P's even lower than that.
Investment trusts have the ability to gear, borrow to invest. Given that you're seeing plenty of opportunities in the UK market, have you been increasing gearing levels?
No, it's interesting enough. The trust has the ability to borrow. And actually, over its entire 13-year history since we first set it up, actually, it hasn't actually borrowed at all. And that's not because we don't, we don't think there's advantage to borrowing, but actually, one, the trust itself can make plenty of money without actually borrowing, and that's a good start because of the added value. And secondly, you really don't want to be borrowed if things get caught out. If you were excited by the election in 2019, when Brexit, which had been a sort of gridlock in Parliament, was now going to be resolved, you could have geared up the fund in the early part of 2020, and then being completely caught out by the pandemic when asset markets came down, and you may have had to actually sell some of your holdings because of gearing at the bottom, locking in that underperformance. We're very, very keen to avoid that. So actually tend to have no gearing, and then after a market setback, if we think the coast is clear, if we think the risk-reward ratio is attractive, gear up after the event. So the last time we've really geared our investment trust was back when I was at Gartmore, 2009, not 2008, but 2009. When markets bottomed that stage, you could see all that shock and awe of quantitative easing at the time. Interest rates have been cut from 5 3/4 to 0.5%. This was an extraordinary period. And then, being ungeared, we were then able to put gearing in right at the bottom and make extra returns for clients. So that's when we use gearing. It's very flexible, it's very opportunistic. Let's not rush our fences, let's wait for them to come to us.
I also wanted to ask you about a trend that's been taking place for a couple of decades now, which is that companies are increasingly staying private for longer. What are your thoughts on that trend? And as an investor who you like to look at the small cap part of the market, does that make your job harder?
Yes, I think there's been very many fewer issues, IPOs. There have been actually a lot more takeovers. So the number of listed companies has actually been reducing. That's been a feature of the UK market. It's been a feature of the US market and other markets which have been doing well. So coming back to it, I think the cost of actually finance, the cost of capital, has been relatively expensive relative to the cost of debt. And so you find that actually many companies have chosen to have more debt, have less capital, and therefore risk capital, and therefore as a result of that, we found that many companies have skewed towards the unquoted. I think going forward, with the cost of debt being higher, with potentially inflation being more persistent, with the risk of geopolitical events becoming more risky going forward, and perhaps the risk and volatility in things like oil price and food prices, we think that actually going forward, having more risk capital, having less debt, actually is the secret of the future. We think quoted companies will vastly outperform private companies going forward, in part because they're more resilient, they don't go bust so fast, but more importantly, as they are able to take advantage of the weakness of others when those which are indebted may be constrained. So coming back to it, yes, it isn't helpful having companies staying private for longer, but we actually still have in the UK market a vibrant universe of small and micro cap companies. If you take the investment companies below, or quoted companies below 150 million market cap, in number terms, they exceed all of the quoted companies above 150 million market cap. There's just bags of opportunity. We're not short of opportunity.
And finally, Gervais, do you have skin in the game?
Absolutely. I think it's important actually that all fund managers back their own funds. I don't invest in anything else other than our own funds and, of course, the parent company.
Thanks for coming in today.
Thank you very much indeed.
That's it for our latest episode of our Insider interview. You can check out the rest of the series on our YouTube channel. Please let us know what you think. You can comment, like. Please do hit that subscribe button as well. And hopefully, I'll see you again next time.